2021 is looking set to be a much more challenging year for protecting and growing wealth. We asked Robert Kiyosaki, author of the #1 best-selling personal finance book of all time, Rich Dad, Poor Dad, for his thoughts. And here's what he says.
There's no correlation today between the stock market and reality. And I think that's really my concern.
Welcome to Peak Prosperity. This is Peak Prosperity co-founder Adam Taggart, welcoming you back to this week's market update, where we try to make sense of these markets. We have a very special guest today, Robert Kiyosaki. Robert is the author of the most successful personal finance book of all time, Rich Dad, Poor Dad. Robert, you've probably done more to help people build wealth outside of the stock market than maybe anybody alive today. But anyways, Robert, thanks so much for joining us today.
Thank you. One of the nicest things about being an author is it was 25 years ago now. And I have young people coming up to me and says, my dad or my mom gave me your book. And I think that's the real joy. That is the joy. So,
well, it made a huge difference in the lives of literally at least tens of millions of people. In fact, how many books ballpark have been sold by now?
Well, legally about 41 million, but the number of pirated copies is probably twice as much.
Okay. That's a tremendous amount. And as somebody who has written a book, Chris and I have written Prosper, which did pretty well for a book. We're still about 41 million copies legally behind you in our sales. But all right, Robert, so I wanted to have you on today to pick up a thread that we've been talking about on the past recent videos here. And it's almost sort of like, where do we start, right? Since you and I last caught up, global GDP has taken a gut punch from the global pandemic. Tens of millions of Americans have lost their jobs. The Fed and Congress have injected trillions and trillions of monetary and fiscal stimulus into the system. And yet, while there's still no clear path yet on how we're going to get back to normal, the financial markets have zoomed off and are back again at all-time record highs. Yet at the same time, the wealth gap is as bad as it's ever been, and social unrest is on the rise. So my question for you, Robert, given that backdrop, is where do you see things headed from here? What concerns you the most, and are there any developments going on here maybe that give you some optimism? But you're a big thinker. I just threw a lot of macro stats at you. Where do you see things headed?
Well, I agree wholeheartedly with you. I'm concerned. As of this recording, we still don't have a real president yet. And I think the more disastrous thing about that is nobody trusts the election anymore. So the election process is now compromised. So no matter who wins and who gets in, America is, I think, permanently divided. I think that's the biggest crime or concern of all, because we've never been this divided. So as far as the future goes, it really doesn't make a difference if it's Biden or Trump. The question is can we keep printing more money, and will people keep allowing the markets to go up? Because there's no correlation today between the stock market and reality. And I think that's really my concern. But they don't get the correlation. The Fed, people love the Fed, don't fight the Fed. But the Fed does one thing. It takes from the poor and gives to the rich. It's the opposite of Robin Hood. And as you and Chris always talk about, the Fed chooses winners or losers.
Yep.
That's called communism. It's central banking. It's everything is communism now. So that's what I'm talking about. There's something rotten in America. And the gap is so wide today. That's the real problem. Who cares about the stock market if we're soon going to go to, as you say, civil unrest? We're not too far away.
Yeah, which is, I think, a growing concern to many people. And as we've mentioned a couple of times on this program, it certainly seems if we keep on the trajectory that we're going on, that unrest problem is only going to become more acute. So Robert, I think people can gauge from the comments you just made, but I knowing you personally, I know you're no fan of the stock market, and your general strategy for wealth building, I think both personally, but what you've advocated for in your writings, is to kind of get out of that casino, because it is a casino, right? The house always wins. The odds are against you as the investors, the dumb money there, the patsy at the table. And you've really encouraged people to take charge of their financial destinies by creating income streams that they own as entrepreneurs, and then eventually turning that wealth into investments and switching over. We can talk about your cash flow quadrant in a second, but making the transition eventually from independent business owner to investor, where really all the way the system is currently structured, all the spoils of the games really go to investors, right? Because that's where you put the tax code in your favor and things like that, correct?
And what capitalists do is we go to war against socialists. So that's kind of my background. I went to military school, so we think differently. I studied military economics, I studied socialist economics, and I studied capitalist economics. And socialist economics, the average person has no idea, is what is taught in business schools today. It's called Keynesian. And Keynesian economics came into focus August 15th, 1981, when President Nixon took the dollar off the gold standard. So at that time, the US dollar became debt. And the only way the dollar could come into existence was somebody had to borrow money. And once I knew that, I went, oh my God, there it is. I had just graduated from Kings Point, the Merchant Marine Academy in 1969. And I was on my way to Vietnam in 1971. And so that's what kind of clouds my thinking. And then taking 3 companies public on the Toronto Stock Exchange really opened my eyes, if you know what I mean. As you know, I can say they stay woke. They stay woke, the woke movement. I woke up. And so when I talk to people about investing, I kind of, for most people, it's survival. And the thing that really saddens me, I see many people today who have lost everything because of socialism. They've lost everything. And how can they shut down small business? How can they shut down small business and Walmart keep operating? How can McDonald's stay operating and the small restaurants get shut down? How dare they do that? So that's socialism and communism and totalitarianism. So as a military officer, that's what we study: military economics, socialist economics, and capitalist economics. And capitalist economics is Austrian school, Mises and Hayek and those guys. And Austrian School of Economics comes from St. Thomas of Aquinas. It was based upon integrity, loyalty, spirituality. And so when Nixon took the dollar off the gold standard, we shifted from Austrian school to Keynesian school. And the average person has no idea what I'm talking about. So that's why I stay out of the stock market.
Great answer. And I actually want to get to financial education and literacy, which I know is a big passion of yours in just a second. But you're absolutely right. We spent a lot of time on this program, I think, trying to complement what you're saying there, which is to kind of really open people's eyes to the fact that the way the system is run right now is it is privatized gains. Right, it's not a capitalist system. It's kind of a crony capitalist system. So it's privatized gains and socialized losses, right? And so what's happening is
you and Chris always talk about that. You and Chris always talk about it.
Yeah.
You guys are saying, those guys pick winners and losers. Well, this COVID, that didn't show you something.
Well, exactly. And to your point, I mean, we've seen
they pick who wins.
Decimation of those smaller companies, as you mentioned, and yet the spoils are flowing to the small mega corporations that are still driving the whole system here, right? It's just not a fair system.
So that's why I've been, I'm a Marine. I love my country, but I'll still fight communism any day.
All right. Well, so to the point that that you mentioned earlier is that you've seen a lot of people already kind of lose everything or lose a lot of what they have. And I think if we project ourselves forward, really just another 6 to 12 months, if the US continues to tighten lockdowns here in the winter because of coronavirus, we're only going to see more businesses, go bankrupt. We're only going to have more layoffs as that continues to happen. We already have tens of millions of households that have lost their income in 2020. and are not going to be going back to work anytime soon. So, and that's just in the immediate, next 6 to 12 months. You've also talked about, some of the greater risks there of a big market correction. If prices are in an asset price bubble that does eventually correct or collapse. We're looking at a future where it may be much harder for the individual to build wealth, at least through the conventional system. And so there probably are going to be a lot of people that are going to really be struggling to build financial wealth going forward.
If there's a crash, and I've been calling for this crash, I called it for 2016, it came in 2020. If that happens, what's your contingency plan? What if you lose your job? What if you lose your restaurant? What if your kids, this happens and all that? So when I talk to people, if the stock market crashes, what's your contingency plan? And the question is, will you get richer? So what happened for me in 2020, Adam and Chris and I have worked together for years and years and years and years. You've always heard me be pretty forthright about it. I don't mince my words.
You don't beat around the bush.
I don't. And I said, hey, if you lose your job, is it a good thing or a bad thing? And the reason I know that is my poor dad, PhD, lost his job. And I saw that and I went, oh my God. The other thing is when I got out of the Marine Corps, my peers went to fly for United Airlines. And the reason Ted Siddell and I are friends is we wrote this book here called Who Stole My Pension? My poor dad in 74 wanted me to fly for United. Well, as you guys know, in 2005, they stole their pensions. And so when I talk to my fellow pilots who are now old guys like me, they're starting all over at 73 years old. They had no contingency plan. So that's how I think. And I know it's different than the way most people think. But that's why when you ask me about the stock market and all that, if I was in it, I'd have a contingency plan. So if it goes down, do I get rich? If it goes up, do I get rich? It's just the way we think.
It's a great point, and it's one that after we finish talking with you, Robert, I'm going to pick up with the guys from New Harbor Financial, because the whole reason we have a partnership with them is basically their risk management. They're always asking that question of, hey, what if the core trade we have, it doesn't go that way, right? So I completely agree with you that is a core question that no matter what you're doing in life, if you're putting yourself above a certain amount of risk in pursuing it, you need to ask yourself those contingency questions. So Robert, having known you for many years, I know more than anything else, at heart, you're an educator. And I kind of believe that even if your book hadn't been as wildly successful as it turned out to be, you still would have dedicated your life to trying to make people smarter about the things that you think they need to know about. And very clearly, financial literacy is a huge passion area for you. Can you just give me a quick background into sort of what you see as your mission in that space? Because I know you're continuing to try to blaze new trails there. And what in your mind comprises a well-rounded financial education for people who are living in the uncertainty of today's world?
So the story of Rich Dad, Poor Dad just told on a financial statement here. So this is Poor Dad. He wanted a high-paying job, and Rich Dad didn't want a job. He had assets. So there's 4 basic asset classes. There's businesses, real estate, paper, and commodities. And I include Bitcoin or blockchain in there today now. So I have oil, I have gold, I have silver, I have that. I own businesses. I have 7,000 rental properties. I have no paper. That should tell you something. Now, I don't recommend people do what I do, because paper, stocks, bonds, mutual funds, ETFs, and savings is the most liquid. These babies are not liquid. So as a Marine, and we're trained to think this way, is that the more illiquid the asset, like a business, you've got to study harder. And real estate, oh my God, you've got to be really, really smart, because you make a mistake in real estate, you're the skipper of the Titanic. You're going to go down, same as a business. And I've gone down with both of these. But that was part of my process. Same as even Steve Jobs lost his business a number of times. So the key word for most people is liquidity. So the reason stocks, paper assets are the best as well as gold, silver, and Bitcoin, is liquidity. And so the more liquid the asset class, you can be an idiot and still do okay because you can get out. So that's kind of the basics, the way I teach people. So I'm a rich man today simply because I have businesses in real estate. And the beauty of real estate is debt. You see, the biggest liability today is cash, because the Fed's printing it faster than we can. They can't even buy enough bonds to print the cash. So cash is a liability, and what's the asset is debt. And the reason I like real estate is, Ken McElroy, my partner, we just bought another $30 million property. The average guy cannot afford $30 million. But when you go to a bank or a pension fund, you say to them, I got this $30 million property, they have a lot of money for you all of a sudden. So those are all the differences, the fundamental differences that are not taught in schools. So the reason I don't have paper is because I can debt and taxes. I mean, I don't pay any taxes legally. Neither does Donald Trump because he's a real estate guy. But paper guys pay taxes. Do you know what I mean? So it's just what we teach. It's not a rightness or wrongness, but I just cracked up because the New York Times says, Trump didn't pay any taxes. I said, well, look at this here. This is book number 2 in Rich Dad, Poor Dad, E, S, B, and the I. Who pays taxes? These guys.
Right, the E and the S, yeah.
And Trump doesn't pay taxes because he doesn't take a salary. He's president of the United States. He doesn't take a paycheck. So he pays no tax. He pays other kinds of tax. But when I was a kid, 10 years old, I understood this. So if I don't have a job, I don't pay taxes. But if I was smart, like you guys, I become a doctor or a lawyer, and these guys pay the highest taxes. So these guys over here are the guys that, like Trump and I, don't pay taxes. Now it drives people like Biden, Obama, and AOC. It drives them crazy. But they have to have the paycheck. So I'm not saying one is right or wrong. I'm saying that's what financial education is, knowing the differences. And then you can make a choice.
Right. And sadly, rightly or wrongly, but sadly, the B and the I sectors are not taught in our education system, right? No. You go through our education system, you're encouraged to go become a good employee or maybe become a professional like a doctor or lawyer or whatever, but they really don't teach any of the other side of the ledger there.
Those are some of the distinctions when I was a young man. Up till I was about 35, it kind of set me on my path in life when I came back from Vietnam. And like I said, the reason Ted Siddell and I are friends is because I remember my poor dad trying to get me to fly for United Airlines. I said, well, first of all, I'm a helicopter pilot, and you don't want me flying your 747. And then my classmates lost their pensions and their jobs. And that's what happens when people don't have financial education. It's sad. It's very sad today.
It is. And so, huge kudos to you, the whole Rich Dad organization. You've built a big empire there in helping people become smarter about, those alternative ways to build wealth and just being sort of a wage slave the rest of your life. All right. So I can't let you go without asking you a quick question about real estate. You mentioned it earlier under assets, but, not only are stocks trading at all-time highs, but real estate has been very richly valued for really the past decade or so. And we're entering into a period of time where there's a lot of tenants that are not going to be able to make their payment, both on the commercial and the residential side of things. Do you have anything to say about the future outlook of real estate from your perspective?
Well, that's a huge concern, but that's why when Ken McElroy, my partner in real estate, the key to real estate is jobs. So when we buy property, we make sure there's a major industry nearby, like a hospital or something like that. And so the security is how secure are the jobs before we buy the real estate here. And that's why, I spent my time getting over to this side here. That's what Rich Dad teaches. We teach this side. You want to go to school and get a mutual fund, you come on this side. But that's kind of the differences there. So I don't recommend what I do. I recommend education. always, no matter what you invest in, because it doesn't make a difference if it's stocks, bonds, mutual funds. It doesn't make any difference. If you're smart, you'll get rich. If you're smart at mutual funds, you'll get rich. If you're stupid, you'll get poor.
But the end emphasis there is invest in your education.
Education, correct. And that's why peak prosperity. And when I met you guys, you and Chris, to me it was a breath of fresh air. Because we're saying the same things. It's like Chris said, what happened when he lost some huge amount of money in the market? He says, "What happened?" Remember that?
Absolutely. Yeah, that was sort of his beginning of the journey when his .com portfolio vaporized.
He talks about the stadium filling with water. Well, the stadium was full. So, all right. You'd better start swimming pretty quickly. That's all I'm saying.
Yeah. Well, it does feel like, we talk about things speeding up exponentially. It does feel like 2020 pretty much filled the stadium here. Yeah. So Robert, look, we'll leave it at that. But look, thank you so much for your time, sharing your wisdom, for everything that you and the team at the Rich Dad organization do. And really appreciate you joining us here, and really hope we can have you on again at some point in 2021 to, give your perspective on whatever, new major changes are happening then, because I doubt it's going to be a boring year.
Well, the future is extremely bright, but you got to think differently. That's all I'm saying.
Yeah.
And the best thing about life is having great friends like you and Chris. It's just fantastic. You've met my friends are all goofballs, but they're smart as whips.
No, I mean, I think one of the things that you personally really it brought to me, in addition to just a great friend in yourself, but is you showed me the value of what an accelerator, what a catalyst it is when you surround yourself with a group of advisors who know more than you do about, the key areas that you want to get better at. And you with your whole Rich Dad Advisor strategy is really, influenced me in trying to recreate the same thing in my own life.
Well, Adam, your handicap is you're an A student and I was a C student.
Yeah, although not in life. I think in the big scheme of life, Robert, you're getting an A+. All right. Well, with that, thanks so much for joining us, Robert. We'll let you get back to your busy life, but thanks so much for taking the time.
No, thank you. It was fun. Thank you, everybody.
Take care, buddy.
Thanks, Robert.
All right, Mike and John. Gosh, it just it seems to get better and better every week, huh? Robert Kiyosaki, author of Rich Dad, Poor Dad, one of the most influential thinkers, influencing probably one of the largest numbers of humans on this earth in terms of the way that they look at money and pursue wealth. Anyways, I did want to pick up right before we get to start talking about what the markets have done in the past week. I wanted to pick up on Robert's point there about contingency plans, because as I sort of gave a nod to, I think that really goes to the core of why Peak Prosperity has arranged the relationship with you guys that we've had over the past decade, because you guys are such, your expertise in risk management is so high that we've got a lot of people that have worked hard to earn a lot of money. They're very worried about the markets. They want to invest actively, but they don't want to be caught if there's all of a sudden a massive market correction. And Mike and John, I know you guys have said in the past, a correction of 50% or possibly more isn't out of the question here. So anything you guys want to say in reaction to what Robert said, but also if you could maybe just sort of riff off of that theme of risk mitigation. Why don't we start with you, John?
Yeah, no, sure. So Mike and I, we've said it time and time again. Yeah, we're financial practitioners, but we studied engineering in college, and it's too long ago to remember if we were A, B, or C students. But the reason I raise that is we think of things in an analytical kind of way, and when you think about investing and life, even in a probabilistic framework, you think about upsides and downsides and probabilities of those different scenarios. And that's where we kind of build our investment acumen, using data and understanding that just because something has gone up doesn't mean it will continue to go up. And in fact, if you look at data, the more something goes up, the more likely it is to not go up, the whole concept of mean reversion. So without that kind of construct of contingency planning or probabilistic thinking, you can, I think, conclude some very wrong things about markets. And that's exactly what happens in major bubbles. A whole lot of folks start to conclude things that just are unreasonable to conclude because they allow themselves to lose track of what the data speaks to the reality of the situation.
All right, well, really well put there, Mike. And we're seeing, more and more, big name people, kind of capitulating, at least in terms of their willingness to cheerlead these markets on, and saying, look, perhaps I might still be long, but like markets are more overextended than I've ever seen them in my life. And so, I think we are, you talk about the different sort of warning lights that you guys are looking on to the dashboards that you monitor and whatnot. It does seem that more and more and more of them are going off. And so, for those folks that are along this market, want to play this market, again, we're not here in these videos to tell people what to do necessarily. We're just here to kind of give you a sense of what where the probabilities lie. And right now, boy, if anybody's watching this who is still along this market, whether it's in a retirement fund or just general stock portfolio or anything, it is definitely a time to be asking those questions about, okay, what if the trade goes against me here? Because so many of these trades are so hyper extended. Even Elon Musk, came out this week and said, hey, look, he was talking to his company. He said, hey, look, guys, the market is giving us so much credit, not just for our future revenues, but for our future profitability, right? Our future ability to build profits off of the revenue streams that we're creating. But he said, if you look at our cost structure right now, it's nowhere near it needs to be. And he said, if we don't figure out how to get more profitable quickly, our stock price, I think the term he used is, he said, it's going to fall faster than a souffle hit by a sledgehammer. Right. So even the guys that are creating some of the most wildly performing securities right now, or assets right now, are saying, look, we're getting a lot of credit that maybe we're not due. And if we don't, figure out how to justify the valuations we have, they're going to be, kneecapped in a heartbeat. So anyways, Mike, feel free to add anything onto what John just said. But, I know we had a couple of days off of the markets last week because of the Thanksgiving holidays, but maybe if you could just give us a recap of what's actually going on right now on the tape with the stock markets.
Yeah, sure. I'll go through the numbers, but yeah, this is a bubble. We've got no doubt in our minds that this is a bubble. Most of the conversations we're having with existing clients and prospects is about this belief that the market will never go down, or that the central bank will never let it go down. And obviously, we can't predict when the turn is going to come, but we know that all of history points to where we are right now as being the single most overvalued and probably risky point in the U.S. stock market, probably in U.S. history. And just to reiterate what you said before, a 50, 60, or 70% decline would be totally expected from these levels. Can't predict that. We can't predict the path of it. What we can say is that with pretty good repeatability and expectation, there's really not a lot of ways to make money from these levels in the S&P, or at least money that you're able to keep. So we continue to urge caution, and for people to reduce equity exposure. Our guideline is, less than a third, get down to 30% or less. It'll be a much smoother ride. You'll have the ability to get more exposed in the markets on pullbacks. There's just there's no game plan. That's the thing. There's no game plan. You talked about risk mitigation. We do have risk mitigation and the ability with options, stop losses, or just the fact that we're out of the market mostly to mitigate risk that we see building every single week that we talk here. So getting to the numbers, not a whole lot has happened over the last week, Adam. The S&P is up again. I mean, literally the S&P is up almost every day, it seems. Even if there's an intraday pullback, it's immediately bought. As we speak, the S&P is up about 35 points since we talked last week. Gold has been weak the last couple of weeks, but it's on a nice bounce, up about $30 since last week, the end of last week when we talked. Volatility is relatively flat, not a lot going on in volatility, except I'd say that VIX stubbornly remains in the low 20s. VIX is a measure of risk, and just stubbornly stays there, nearly double where it was the previous few years, on average. And, lastly, one thing that we think is a story that no one's really watching is yields on the 10-year bond. We mention it every week. And, we had We were probably at about 0.88% or 88 basis points on the 10-year when we talked last week. Yesterday, we shot up to 95 or 0.95%. So again, we're knocking on the door at 1%. I think the charts anyway are showing that it wants to break through the 1% to the upside. It just seems to be a story that no one's talking about. Interest rates start to go up. Every little bit that interest rates go up affects the, this mammoth, gigantic pile of debt that we have. So that could be a surprise. That could certainly be a catalyst. Who knows what the catalyst is for the next market downturn? People ask us that all the time. But keep your eye on yields. We're looking at 10-year yields, and things are frothy. They're very, very frothy and very, very dangerous. So be careful.
All right. I want to just comment on a couple of things that you mentioned there, Mike. One is that VIX is remaining, you said stubbornly high. I think that's a good adjective, because usually VIX is, I mean, it's probably the most monkey hammered, beaten, signal we have out there. It's one of the things that if you think that the market is controlled by a lot of power players, the way in which people have made a lot of money in the past bunch of years has been hammering the VIX. And it seems that they're not able to push it around as much as they used to be able to. And I think that's what you're saying, Mike, is that's a sign that maybe their grip, their iron grip over the system may be weakening a little bit. And that's a prelude you would expect to see before, a market decline is VIX beginning to rise back up. You mentioned gold and the miners. We've, talked in a number of videos in the past about gold, especially as it made its big run this year from, 1,300 to over 2,000. A lot of people were asking, hey, is it too late to get into gold? And they were asking that when gold was about 2,000. We did talk with a few experts who said they did expect a cooling off period. That's sort of what we've been seeing. I think an open question is the bottom in or not? But if you hadn't yet bought into gold, or in particular, the miners, if you wanted to get miner exposure, the miners have cooled off quite a bit. And so if you felt like you missed out in that initial run, this is not a bad time to be looking at, potential entry points. And again, the guys at New Harbor would be great guys to talk to you about that. Bitcoin also has continued to perform really well. It's back above 1,900. We've been following it for the past couple of months here on the program. I think it remains sort of at this moment where it's either going to probably move very much to the upside as big new pools of capital begin to come in and legitimize that market, or perhaps it moved too far too fast and there could be another cooling off period there, like the precious metals have seen. Interestingly, Bitcoin went from 19,000 to 16,000, which you could call a cooling off period, but I think it lasted like a matter of hours. It was not very long lived, which is a sign of strength. So who knows what's going to happen there, but we'll be tracking it. And last, Mike, you mentioned yields. Concurrent with that, a big theme of the past couple of months has been the weakening of the US dollar. And that's been, another sort of justification for why financial assets have been going up. There's sort of a general dollar goes down, stock goes up kind of correlation and just general assumption by the market. You're right, Mike, that rising yields kind of changed the game for everything in terms of valuations. But there are not a ton, but more voices beginning to come out saying, hey, the death of the dollar may have been grossly exaggerated or been prematurely declared. And a surprise rise in the dollar here would catch an awful lot of the market by surprise. Charles Hugh Smith actually just did a great piece on this on his website, which if folks haven't read yet, I'd recommend you go check out. But that could be one of the big surprises of 2021. That's one we'll be keeping our eyes on here. Last, John, I'll just ask you to comment on this. A huge theme of 2020 has been all the liquidity going into the market, the stimulus, both monetary stimulus from the Fed and fiscal stimulus from Congress. It looks like something's going to get passed at some point here in terms of additional stimulus from Congress. But it looks like, it's probably going to be smaller than the market was initially anticipating. That may have some impact going forward, depending upon what gets announced. But also, we've got Janet Yellen stepping in as Treasury Secretary here. And I have been reading articles about, and it's a little hard to explain and get into with the time we have here, but that over the course of 2020, the Treasury has accrued a balance of above $1.5 trillion in cash that it's essentially going to have to distribute before, I think, August of 2021. And that could be another wave of liquidity coming in here, propping up markets. So the general question for you, John, is as you kind of look at the liquidity story going forward, does your crystal ball yet sort of give you confidence one way or the other that we're going to see more propping up than we've seen before, or at least enough propping up to keep assets where they are? Or do you see more signs saying people are going to be disappointed, markets are going to be disappointed, better to position here for defense?
Yeah, Adam, it's really hard to say. I mean, in a textbook way, it kind of depends on how that liquidity is deployed into the economy, right? That makes all the difference. If it's deployed by the central bank, buying up junk bonds versus other more stimulative measures, maybe to fund infrastructure or things like that. So it's kind of hard to say without knowing the details there. But the whole idea that there's this concept of liquidity going into the stock market is kind of a little bit of a hall of mirrors, because there's no such thing of like net money coming into the stock market, because for every dollar that comes in, every dollar of stock that is bought with cash or liquidity, the seller of that stock is taking that cash. So it's not like the net amount of money in the stock market is increasing. It's just changing hands, and it's the eagerness of the speculative, fever that causes prices of stocks to go up, not the fact that there's liquidity in and of itself. Because frankly, in a cascading down market, liquidity doesn't necessarily do anything to stop that, and we saw that on full display when the tech bubble burst and when the housing bubble burst. Didn't matter how much the central banks kind of tried to turn the spigots on and lower interest rates. People were running for safety, and guess what? 0% yielding cash was a pretty desirable place to be when people saw their account statements dropping 3% a night. So it's kind of hard to say. I wish I had a better answer for that. The one thing I'll just comment, just getting back to the numbers, with the weak dollar and some of the things we talked about there, we have started to see some encouraging outperformance on the part of foreign stocks, foreign equities, especially emerging market equities, relative to U.S. stocks, for example, which we have long said, and the data speaks to this, that U.S. stocks are vastly overvalued, whereas emerging market stocks, for example, are actually not that badly overvalued. They're actually, in some context, a pretty good value. So we've had kind of a spread trade, if you will, in place for our clients that have account sizes that will allow it in place. So we're starting to see that play out in a way that we've kind of been expecting for some time. So
great, and I know you've had that position for a while and have had that thesis. I'm just curious, among the markets that you're invested in, are there any particular ones that are popping or performing of any material note right now?
Well, we actually have a broad exposure there. We like the broad complex, and this is what you get in very late stages of markets. Rather than reward for picking slivers. The markets move in tandem, and it's better to be in the macro areas of the markets, whether it's domestic, foreign, certain sectors. But so we have a broad exposure through a broad ETF, frankly, to get broad exposure to the emerging markets.
Sure. So, sort of taking the safer approach of there's a lot of beta just in the average itself. Get the beta safely. Don't worry so much about catching the alpha with greater risk, right?
Exactly right. Yeah.
For many people, as we talked about with gold miners, that's probably for most people who are going to invest in gold miners, that's probably the same strategy to use as well. All right, guys. Well, as we wrap up here, John, your answer there basically, I think puts a bright light on the fact that we're in such a hard to understand market environment right now, because if you just kind of look at all the data, prices should be undergoing, a pretty substantial correction here. But of course, the data has been saying that for a long time, and yet we've been able to power higher and higher. So, in this type of market, you want to be, if you're going to be dancing, you want to make sure you're dancing close to the door. And of course, everybody thinks they're going to be one of the first out the door, and just statistically, that can't be the case, right? So you want to work with an advisor that is really thinking critically about all of these issues that we're talking about here. And guys at New Harbor, I'm going to talk about your free consultations that you offer in just a second here, but we are now in December. And I presume that at the end of the year, there's lots of questions that people should just be asking themselves and their financial advisors about their portfolios. given both the performance of the portfolio over the year? Does it need to be rebalanced? Is exposure in certain areas, too great or too little? Maybe there's some tax considerations that need to be taken into account. But am I correct in saying this is a good time for people to be reaching out to their financial advisor, whether they're working with you or somebody else, and to start asking those questions?
Yeah, absolutely, Adam. All those issues that you just mentioned are good investment and financial planning issues to talk about, things that we bring up with our clients, and we're going through a round of outreach to clients as well to talk over the next month or so about all of those issues that you just mentioned. So yeah, really good to reach out and ask your advisor about those.
All right, great. So my direct advice is go have those conversations with your financial advisor or a financial advisor that understands your situation and understands the type of risks we've talked about here. If you'd like to talk to Mike and John and the team at New Harbor, we've set up an arrangement with them where you can do that for free. I've talked about it enough in this program in the past. I won't get into details here, but if you're interested, stick around to the end of the video. We give you all the details on how to set up a free consultation. Literally takes you just a couple of seconds. All right, guys, quick wrapping up here. Folks, if you haven't yet, just click the like button on this video. And if you can too, if you haven't already, subscribe to this YouTube channel. That way, whenever we have a new video like this that comes out, you'll get alerted via an alert and don't have to go hunting down to find out if there's a new video that's been released or not. And with that said, Mike and John, thanks again for another week. Working on another great set of guests coming up to close out the year here, but we've had a pretty phenomenal stretch over the past couple of months here. So anyways, thanks for your guys for your participation in that. And thanks for being such great guides for the hundreds of people that we've sent over to you this year. We keep getting feedback about how wonderfully people are finding it to be able to talk to a financial advisor who finally has the same sort of worldview as them, shares the same type of concerns, can talk about the same types of issues that we've been talking about in these videos. So a huge note of gratitude from Chris and I for that. And with that said, guys, whatever the markets do from here, we will be tracking it week by week going forward. And I look forward to seeing you guys next week.
Thank
All
you,
right,
Adam.
Adam,
We
thanks
enjoy
a
it
lot.
every week. Appreciate it.
We'll see you next week. Take care.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.